So apparently, life insurance companies like making money unless they're selling whole life insurance. Because it turns out there's something really special about whole life insurance that would make it far less profitable than term life insurance. At least that's the claim that's peddled by a certain number of life insurance agents, specifically ones that are focused on selling you whole life insurance as the core focus of your new venture in self-banking, also commonly known as infinite banking, that super secret, not actually so secret trick that the wealthy actually probably don't use as a way to grow their riches beyond belief that nobody let you into. But somehow, some random person who was wildly unsuccessful at practically everything else he or she tried to do magically found the way to harness the power of whole life insurance to unlock the riches that were handed down by dynastic families such as the Rockefellers and the Carnegies. Though the Carnegies aren't really still rich anymore, so I guess that's a bad example. Never mind. In any event, the claim goes something like this. Whole life insurance is special. Whole life insurance is unique, and whole life insurance can be put together in such a way that profits are virtually zero. Good for you, I guess. Bad for, I don't really know. But in any event, you can buy whole life insurance in a way that would help you maximize its cash building potential, which is actually true. But the profitability of the insurance company might change in a slight way. It doesn't necessarily mean that whole life insurance is something being issued by the goodness of the heart of life insurance companies. But of course, these agents like a good story, and so this good story has another great statistic behind it that sounds mind-boggling, and it's kind of sort of maybe true. The claim is that only 2% of term life insurance policies ever pay a claim, a death benefit, to the policyholder. This statement, supposedly true, is old. It was old when I heard it 20 years ago, and it's been perpetuated within the industry for decades as a way to malign term life insurance in favor of buying whole life insurance. Because if only 2% of term life insurance policies ever pay a claim, and whole life insurance is guaranteed to exist for your entire life provided you pay your premiums till the policy is paid up, then it would follow then whole life insurance must pay 100% of the time. Sounds cool. Probably not true though. Now, if you would like to reference the industry data that shows you that only 2% of term life insurance policies pay a death claim, guess what? It doesn't exist. Closest we get is research that was done by Penn State University back in the early 90s that looked at many thousands of term life policies and gave us some insights on what people did with those policies. The real findings were things like a large number of those policies were either converted or terminated much more sooner than you'd think. That research identified that 45% of all term life policies were either converted or terminated within their first year of existence. And by year 3, 72% of all those term policies had either been converted or terminated. The research further claimed that over the lifetime of those term policies, looking at their level term periods, nearly 90% of those policies were canceled, so they never paid a claim. Now, this research was never corroborated by anyone else. It wasn't peer-reviewed. It just sort of existed and then faded into obscurity. But enterprising sales agents decided they would make some weird extrapolations and declared that from that, only 2% of term life insurance policies ever paid a claim. The truth of the matter is, the life insurance industry does not actually publish claims data. Not in a way that's meaningful for you and I to make an inference such as this. The industry views the actual payout rate of policies as being somewhat proprietary and something that they are not going to release to the general public because their competitors could get a hold of this, and that would put them at a disadvantage when it came to their pricing strategies and their competitiveness against each other. But we do have some data from third-party researchers that looks at the overall payout of claims from the life insurance industry, and that data suggests that roughly 2% of all the outstanding life insurance policies in force result in a claim paid each and every single year. This is very different than only 2% of term policies pay a claim. What this is telling us is, of all the life insurance policies that exist, this is inclusive of term life insurance, whole life insurance, and universal life insurance. Of all of them, roughly 2% on average per year end up paying a claim. That doesn't mean 2% lifetime. It just means 2% of all those that exist right now this year. Now, that may seem like a really small number, but if you think about the financial viability of the insurance industry as a financial intermediary, the number is probably well within reason. But here's a data point that's not going to make those whole life salesmen all that happy. It turns out that nearly 70% of all the claims that get paid each and every single year are paid out by, now get this, term life insurance policies. There are a multitude of reasons that could explain why term life policies would actually pay out at higher rates than whole life policies. Chief among them is the fact that term life insurance policies don't have cash value. So there is no incentive to terminate a term life insurance policy. If you own one and you decide you don't really need the death benefit, but the premium isn't really all that big a deal, there's a chance you might keep it and you could die while you're waiting for your level term period to end. Whole life insurance, on the other hand, does accumulate cash value. If you get to a point where you decide that the death benefit doesn't make sense anymore, you could cash out the whole life policy. And because whole life premiums are pretty significantly larger than term life insurance premiums, I would hazard the guess that there is an incentive for a large number of Americans to cancel their whole life policy and stop the premium payment, and then take the cash to do with whatever they feel like. But there's something else about this data that is quite convoluted and needs to be evaluated a little bit closer in order to identify some potential problems with the facts as we state them when it comes to term life insurance payouts. First, if we go back to the Penn State University data, that did openly admit that many of the policies were converted. A converted term policy is generally not going to be counted as a death benefit paid for their term, but instead will count as death benefit paid for whole life insurance, or whatever the policy was converted to. It could be universal life insurance as well. In that situation, we might be overstating the number of claims that come from whole life or universal life insurance because they started as term policies, and there isn't much allowance to figure out and track where exactly people transferred their policies and what happened to them later. In addition to all of this, there's something else about the term life marketplace that you'd probably only know if you've been around for a little while. From roughly the 1980s through about the 20-teens, the term life marketplace was under an ever-evolving pricing situation. As insurers were rolling out term products decades ago, they were trying to figure out what the right premium price was. And it turns out they were a bit heavy-handed in their reservations to competitively price their term products, which is to say, they overpriced them. And so this unfolded a multi-decades-long period of life insurance companies issuing new term life policies with better premium pricing than previous life insurance products they had brought to market. As such, many Americans constantly replaced their term life insurance policies with new ones with the same death benefit and cheaper premiums. This, unsurprisingly, causes a lot of observations counted as term policies that never paid a death benefit. This is not a testament of failure of term life insurance. It's an evolution of the industry as it was getting more of a handle on what the appropriate price for term life insurance was. Now, while many of these agents are very willing to tell you what the supposed payout claim rate of term life insurance is, they're not so ready to tell you what the payout rate of whole life insurance is. The truth is they don't know. But my speculation is they're probably much closer to one another than you think. As we already discussed, 2% of all policies pay a claim, and 70% of those are term life insurance policies, which would infer that whole life and universal life insurance payout rates are substantially lower, actually. This doesn't make whole life or universal life insurance particularly bad. And again, as we already covered, there's lots of reasons why somebody might not keep a whole life or universal life policy to death. But what I want to attack here is this idea that term life insurance is intentionally designed to fail in order to make it more profitable. That is, at best, an extremely pessimistic way to look at the situation. And at worst, a claim that is used to intentionally manipulate you into buying something you may not need. Ultimately, the right life insurance policy for you is the one that meets your specific needs. Its supposed payout claim should be immaterial to your ultimate decision. But if whole life insurance really was not that profitable compared to other life insurance policies, the concept of dividend-paying whole life insurance wouldn't get off the ground. The dividend payment on a whole life policy represents profitability of the insurance company, and more specifically, profitability of whole life insurance. While it is certainly true there are mutual insurance companies that use profits gained from other lines of business to feed into the dividend payable to whole life policyholders. You better believe that a substantial percentage of the profits that get paid to whole life policyholders is absolutely attributed to whole life insurance. And unprofitable blocks of whole life insurance have certainly been a drag on dividend payouts to whole life policyholders. You need look no further than Ohio National whole life policyholders to get a good feel for what happens when the company struggles with profits and specifically struggles with whole life profitability. But there are other insurance companies, other mutual insurance companies that have old closed blocks of whole life business on the books that get a different, lower dividend than current open blocks of whole life insurance, because those old closed blocks have old insureds who are, for the most part, getting less desirable from an insurance standpoint each and every single year. As a result, their lack of profitability is driving the dividend payable on those whole life policyholders down. So if whole life insurance is not very profitable, there will not be much in the way of dividends to be paid to whole life policyholders. This is a really interesting paradox that certain insurance agents are going to have to address. If whole life insurance really isn't all that profitable, how on earth is it going to be a good long-term bet for cash value growth via the payment of dividends? The truth is that whole life insurance is plenty profitable. There is a symbiotic relationship that exists between policyholder and insurance company when it comes to the process of issuing policies to them and taking the premiums that are part of those policies and investing them for profits. Life insurance itself is a profitable business. That feature also feeds into the profitability and therefore dividends payable to whole life insurance policyholders. In other words, it's not a zero-sum game. You don't have to be highly guarded when it comes to whole life insurance in an effort to ensure that the insurance company isn't making more money off you. While there are ways that you could buy whole life insurance somewhat stupidly, that would not be very conducive for cash value accumulation. That doesn't have much to do with the overall profit motive of the insurance company, and everything to do with buying the right product for the right circumstance. It also doesn't mean that if you buy term life insurance, you're a sucker and the insurance company is making a killing off you. And just because they brought it up, the profitability of whole life insurance is actually quite high relative to other insurance products because when you use a dividend to purchase paid-up additions, which is, by the way, a key piece of accumulating cash value in a whole life policy, you are buying additional life insurance. Insurance industry loves this. The ratings agencies love this, and it's one of the reasons they often identify mutual insurance companies that issue a lot of whole life insurance as having really solid financial circumstances. They can continuously sell more life insurance to their policyholders each and every single year with the dividend that they pay them. There are some who will misinterpret that to be a bad thing, but the truth is it also builds additional value of the whole life policy and does accumulate greater cash value. In this sense, whole life insurance and life insurance companies that issue whole life insurance are acting more as asset managers with the cash that's housed inside a whole life policy. There are certain guarantees that they're providing by virtue of the life insurance contract, so of course it's more expensive than your typical asset management situation. But there is a net benefit to doing this, provided that you buy the right whole life product for a cash-focused accumulation. But the idea that there's some sort of battle between whole life insurance or term life insurance or universal life insurance, and you have to pick the right one, otherwise you're going to get screwed, is really a terrible way to set things up. It's also an awful way to look at life. And it's simply not true. Every life insurance company that wants to issue a cash-rich life insurance product does so. There isn't an evil motive to extract your money from you. And if your agent sells you a life insurance policy that is entirely not indicated for cash accumulation, that's not the life insurance company's fault. And sure, there will be people who don't like whole life insurance, they don't like cash value life insurance, and they'll tell you not to buy it. Their reasons for doing that are their own, and I really don't want to get into the idea behind what goes into their psychology. But their opinion is developed from life experience or what they understand to be the circumstances, right, wrong, or indifferent. Whole life insurance is a perfectly fine product. If you want to buy it and accumulate cash within it, you'll do quite well. But do it because you understand it and do it because you like what it has to offer. Not because somebody told you that you're an idiot if you buy term life insurance because you're just renting death benefit.